The first atomic bomb was dropped on Hiroshima.
Over humanity!
The fires of frustration and discord are burning in every
Let us
city.
not forget for a moment the toils and efforts that lie ahead.
They say that those who forget their history are condemned to repeat it. This is the History Lessons Podcast with certified financial planning practitioner Patrick Huey, author of History Lessons for the Modern Investor, and your guide to financial wisdom in the past, present, and future. You ready? Good. Let's get historical.
Hey, I'm Patrick Huey, author of History Lessons for the Modern Investor, and this is how history can help inform your investments, retirement, and tax planning for the week of December 22nd, 2025. Today, we're going to focus on The Truman Show, how a former president can teach us to win in the most boring of ways. That's because on December 26, 1972, Harry Truman died and left us a blueprint for plain vanilla prosperity. Truman died on December 26, 1972, the 33rd president of the United States, and he died in Independence, Missouri, at the age of 88. By the time he passed, the haberdasher from Kansas City, who once seemed wildly unprepared for the presidency, had overseen the end of World War II, the Marshall Plan rebuilding Europe, the birth of NATO, and the early Cold War. Not too shabby. Yet Truman retired to a modest life. He went home, walked to the library, lived on a military pension and later presidential pension, and refused to cash in on his fame with paid corporate boards or big speaking fees. He famously said, "You want to know what a president is? He's an employee of the people." Boy, has that statement not aged well. His personal finances, unflashy, disciplined, and grounded in basic Midwestern thrift, stand in sharp contrast to today's celebrity wealth culture. For individual investors and retirees, Truman's life is a reminder that security and dignity come less from heroic stock picks and more from boring, repeatable habits executed over a long period of time. Here then are 4 lessons for the modern investor drawn from Truman's life and legacy. First, live below your means, even if your title is fancy. As president, Truman made weighty decisions that literally changed the world.
A short time ago, an American airplane dropped one bomb on Hiroshima.
After office, he still lived in the same family home, drove his own car, and walked around town. No yachts, no mansions. Many people today make the opposite move, living as if their peak earning years will last forever and letting lifestyle creep eat what could have been their compounding engine. For retirement, the most powerful lever you control is your savings rate, not your investment genius. A Truman-style approach, spending less than you earn, even when income is good, does more to build lasting security than chasing any single hot investment ever will. And yes, that includes crypto. Second, don't confuse status with a financial plan. Truman had the ultimate title, but no real fortune. In fact, his modest situation is part of why Congress created the presidential pension. Titles and careers can vanish, sometimes very quickly. Pensions and paychecks can change. If your plan is, I'll always make this much, or my business will just keep growing, you're assuming the world will cooperate indefinitely. Real retirement planning starts by separating ego from math. What do you actually need? What does your current savings rate, asset mix, and time horizon realistically support? And what happens if your status suddenly isn't your safety net?
What has been done is the greatest achievements in history.
Third, simplicity and transparency beat clever and costly. Truman wasn't a financial engineer by any stretch of the imagination.
We have spent more than $2 billion.
He didn't have access to structured products, options overlays, or tax shelters. But what he did have was clarity, income, outgo, and a basic sense of what he could and couldn't afford. Individual investors often get seduced by complexity, high-fee funds, opaque annuities, frequent trading, or strategies that sound smart but are pretty difficult to explain. In practice, a Truman portfolio, broad diversification, reasonable risk, low costs, and a clear withdrawal strategy can be more effective after taxes and fees than an elaborate structure you only half understand. If you can't explain your approach in plain language, you may be paying for more sizzle than steak.
Let there be no mistake.
Finally, taxes are part of the deal. Plan around them, but don't ignore them. Truman lived in an era before Roth IRAs, HSAs, and today's alphabet soup of tax-advantaged options, but the principle still stands. What you keep after taxes and inflation is what funds your life. Many retirees and pre-retirees focus on pre-tax account balances without asking, how will distributions be taxed? What does required minimum distribution math look like? Would partial Roth conversions today reduce my longer-term tax burden? Thoughtful use of account types, asset location, and timing of your withdrawals can quietly add years of comfort to a portfolio. It's not glamorous, but then again, neither was Truman. And that is the point. Here's my final thought. Harry Truman's story isn't about getting rich. It's about finishing well, on his own terms, with integrity, and without needing the world's approval. For the individual investor, especially in this holiday season when spending and comparison run wild, Truman's life offers a different standard of success. Enough to live with dignity, the freedom to say no, and the satisfaction of knowing your plan is built on habits that you control, not on headlines that you don't. You don't have to be a president to do that. You just have to decide what enough means and build a life and a portfolio that quietly, steadily achieves it.